Welcome, ADK community. Thanks for joining us today. Our purpose will be really to focus on the four types of bear markets, with our main focus being on the structure bear market. If you really take a look at the first, I'll call it normal. It doesn't necessarily feel normal because in order to be a bear market, the stock market has to drop by 20%. I call it normal because there's a lot of activity post-World War II. On average, about every 2 years, you'll see normal pullbacks. Some of them don't quite register to the true 20% pullback. And from peak to trough to peak, you're looking at months. Then you have the second type, which is cyclical. Cyclical simply means that the economy has expanded, run its course, hits a recession, and then typically 3 to 9 months prior to the recession, you have the market pullback, again, 20+%. Then you have event-driven. Event-driven are the fastest, meaning that the drop is the quickest. As a result, the recovery typically is the fastest as well. According to Goldman Sachs research going back to the 1800s, an article documented through MarketWatch in March 14th stated that the average peak to trough to peak on event-driven is 15 months. Good examples of that would be the COVID-19. Another would be going back to the oil embargo, the OPEC crisis in the 70s. And then today's main feature would be what I'll classify as structural bear markets. Clearly, they are the worst. When you take a look at Goldman Sachs research, from peak to trough to peak to total recovery can be as long on average as a decade. When I think about a structural bear market, you'll see the chart in front of you titled The Financial System Structure. I think of it as like the anatomy of the financial structure. It's fluid, so the graph sort of is trying to illustrate it in terms of something we can make sense of, something more tangible, where you have banks and governments as sort of the foundation, if you will. And then you have institutions, whether or not it's hedge funds, pension funds, corporations. There's the walls, weight-bearing. And then the ceiling would be like the consumer and neighboring countries. So metaphorically thinking of it in terms of a house, that's the financial structure. If you have some type of a external force, normally that's something that ends up being what we classify as popping a bubble. The bubble itself happens internally with the structure. So some examples would be the Great Recession. Great Recession really was pretty stratospherically amazing when you take a look at it. Affected banks, it affected corporations, it affected the consumer, it affected institutions. So much of the structure was imploding that the central banks, if they had not stepped in, it clearly would have been a depression-like environment. As the president of the Financial Planning Association, I had the good fortune of attending a symposium at the St. Louis Fed, and one of the speakers who had been in the New York Fed made a statement, and he said that had the central bank not stepped in, that we would have had a complete financial system collapse. Now, granted, that's one person's opinion. He was retired, so no longer in the system. He had not necessarily any political gain, but I do believe that he was accurate. We could argue whether or not central banks' intervention is helpful long-term or whether or not it hurts, but clearly in the midst of a crisis like that, it causes the drop to be less severe and the recovery to begin sooner. That same Goldman Sachs research illustrated not only that the average is over a decade for recovery, but that the market drop is the most severe, over 50% on average. When you take a look at another structural bear market, you go back to the tech bubble. What most people forget, they think of it just purely on the dot-bomb perspective, but we also had corporate accounting scandals and things that just perpetuated in multiple dominoes. It really never got to the bank and the government level, but it certainly hit the corporation level very hard and much to do with the consumers. But because the banks weren't involved in that one, the recovery wasn't as long as in the Great Recession. Interesting little Cliff Clavin trivia. The first documented bubble would be classified as the tulip mania. You have to go back to the Dutch Empire in the 1600s, and it was absolutely crazy. You see in front of you a chart that we've put together, and you can kind of see in respect to you have some kind of a variable asset, and this tulip mania was a tulip. And hard for us to imagine, but in the Dutch culture in the Netherlands, there was a lot of prestige and much cultural elevation the better tulips that you had on your property. The next ingredient is available credit. So now you start to see an interesting asset. Then you see credit where people start being able to purchase this variable asset on credit. And then you see that greed and fear of missing out driving it to a whole nother level. And then the asset bubble forms. For a while, it's just trading at a premium, and then we clip over to bubble. There is no definition of when that transition would move from premium priced to bubble priced, but clearly the bubble price is unsustainable and it's at ridiculous levels. Greenspan, the Fed chairman back in the 80s and part of the 90s, referenced bubble as irrational exuberance. As much as we hated to hear him say that while he was the Fed chairman, he really hit it on the head. And then at some particular point, there's a trigger event that pops that bubble. And then on the other side of it, you have what I would classify as just a really negative feedback loop, where selling begins and then panic sets in, creditors aren't being able to get paid, just a severe crisis of selling and panic, ultimately concluding in a complete market crash. Some resources if you enjoy reading. Manias, Panics, and Crashes is one of my favorite books by Charles Kindleberger, and the most recent versions have been updated by Robert Aliber. We also have Devil Take the Hindmost by Edward Chancellor. I think it's a little bit more witty in its writing and a little bit less academic. Both are great resources. If I had to pick one or the other, as a customer, I probably would read Chancellor's Devil Take the Hindmost. If you're more interested in the academic part, I probably would do Kindleberger's. In conclusion, as a client of ADK Wealth Advisory, just know that we're constantly evaluating, not just in the U.S., but globally, are there bubbles inside of any of our financial system structures? Because leading up to it, we will attempt to take less risk. And certainly once we perceive that a bubble burst and we believe that there's going to be structural problems, we would take additional defensive measures. In conclusion, I'd just like to say thank you very much for the trust that you placed in our team. We'll do the very best that we can for you, and God bless. Take care.